Disclaimer.
They call me AG, and I've spent enough time studying financial disasters to know what one looks like before it hits. Right now, 40 million homeowners are sleepwalking toward 2026, and somebody needs to turn on the lights before they step off a cliff. Picture this scenario. You locked in a mortgage at 2.9% back in 2021. Your monthly payment on a $400,000 home runs about $1,780. Now, imagine your company offers you a dream promotion in another city, or your aging parents need you closer to home, or your kids have outgrown your 3-bedroom starter home. You want to move, you need to move, but here's the problem that's keeping you awake at night. If you sell and buy a comparable home today with current mortgage rates hovering around 7%, your monthly payment jumps to $3,200. That's an extra $220 every single month, over $18,000 more per year, for essentially the same house. You're not alone in this trap. Right now, 63 million American homeowners are locked into mortgages with rates below 6%. And according to Federal Reserve data, a staggering 80% of us cannot afford to move without facing payment increases that would fundamentally alter our family budgets. And this isn't just an inconvenience. We're witnessing the largest lock-in effect in American housing history, a financial prison with interest rates as the bars. Here's where this story takes a darker turn. While we've all been focused on whether home prices will come down or interest rates will drop, something far more dangerous has been building in the shadows of our financial system. The commercial real estate market, the office towers and shopping centers that form the backbone of our cities, is quietly imploding. And when I say quietly, I mean the kind of quiet that happens right before an avalanche. The numbers should grab our attention immediately. According to the Mortgage Bankers Association, $560 billion in commercial real estate loans are coming due by the end of 2025. That's $500 billion in debt that needs to be refinanced. In an environment where office buildings sit empty, where remote work has permanently changed how we use space, where property values have collapsed but the loans remain at pre-pandemic levels. Think about the downtown office building in your city, the one that used to have every floor lit up at night, where thousands of workers streamed in every morning. Today, it might be 40% empty, maybe 50% empty in some major cities. The owner took out a loan when that building was worth $100 million, but now it's worth $60 million. When that loan comes due in 2025, the lender faces a brutal choice. Extend the loan and pretend everything's fine, or force a reckoning that exposes the loss. This is where our locked-in mortgages and commercial real estate defaults collide in ways most Americans haven't connected yet. Regional banks, the community banks that many of us trust with our deposits and our home loans, hold 80% of all commercial real estate debt in this country. Federal Reserve research shows these smaller banks are 5 times more exposed to commercial real estate than the major Wall Street banks. When a commercial property defaults, it doesn't just hurt the property owner. It strikes directly at the balance sheet of the bank that loaned the money. Let me paint the picture of what's already happening. As of mid-2025, commercial real estate delinquency rates have climbed to levels we haven't seen since the 2008 financial crisis. The Bank for International Settlements reports that 44% of office buildings in major metropolitan areas are now underwater, meaning they're worth less than the loans secured against them. But it's not just offices. 14% of all commercial properties across every category are in negative equity. You might be thinking, okay, but my house isn't a commercial building. Why should I care if some office tower in downtown Manhattan goes bust? Here's the connection that keeps banking analysts up at night. Your mortgage and that office tower loan often sit on the same bank's balance sheet. When commercial loans start defaulting, banks face losses that force them to tighten lending standards, reduce their risk exposure, and, in the worst cases, face the kind of liquidity crises that can spiral into broader banking problems. We saw this pattern before, during the savings and loan crisis of the late 1980s. Commercial overbuilding led to regional bank exposure, which then spread to residential markets through a contagion effect that most people didn't see coming until it was too late. The difference this time, we have tens of millions of homeowners with sub 6% mortgages creating an artificial stability in the residential market, masking the underlying fragility that's building. The lock-in effect is actually hiding the weakness in our housing market. On the surface, delinquency rates remain relatively low. Most homeowners are making their payments on time because those payments are affordable at 3% or 4% interest rates. But this creates what economists call a liquidity trap in the housing market. With so few homes available for sale because nobody wants to give up their low rates, inventory has dropped to historic lows in many markets. This artificial scarcity has propped up home prices even as affordability has reached crisis levels for anyone trying to buy with today as 7% mortgage rates. Here's the mathematical reality that nobody wants to discuss openly. This situation cannot hold indefinitely. Life happens. People get divorced, they lose jobs, they have medical emergencies, they inherit property, their kids go to college. According to housing market research, roughly 8% of homeowners move every year under normal circumstances due to life events alone, completely separate from choice or desire. That's about 5 million households annually who would move if rates weren't a factor. Right now, that natural mobility has been cut in half. We're seeing only 4 million existing home sales per year compared to the normal 6 million. Those 2 million suppressed transactions represent families who want to move, who need to move, but who are financially trapped by the rate differential. The pressure is building like water behind a dam, and here's what should terrify anyone paying attention to systemic risk. When the commercial real estate defaults accelerate through 2025 and into early 2026, regional banks will tighten their lending standards dramatically. They'll require larger down payments, scrutinize income more carefully, and reduce the total number of mortgages they're willing to originate. This means when life events finally force those locked-in homeowners to sell, the pool of qualified buyers who can afford 7% mortgages will shrink even further. We're setting up a collision between forced sellers and disappearing buyers, all happening against a backdrop of regional bank stress and commercial real estate losses. The lock-in effect isn't protecting us. It's concentrating the risk, creating the conditions for a sudden, sharp correction when the dam finally breaks. This isn't speculation or fear-mongering. This is what the data is telling us when we connect the dots between mortgage rates, commercial real estate exposure, regional bank balance sheets, and the mathematical certainty that millions of homeowners will eventually need to move despite the rate penalty. The question isn't whether this pressure will release, it's when and how violent the release will be when it comes. If you think I'm connecting dots that don't exist, let me take you back to a crisis that most Americans have forgotten, but that banking regulators still have nightmares about. The savings and loan crisis of 1986 to 1989 followed this exact playbook, scene by scene, like we're watching a rerun of a disaster movie, and nobody remembers how it ends. Here's how it unfolded back then. Commercial real estate developers went on a building spree throughout the early 1980s, fueled by easy credit and tax incentives that made overbuilding almost inevitable. Office parks sprouted in suburbs, shopping centers multiplied beyond demand, and the savings and loan institutions that financed this boom convinced themselves that real estate only goes up. Sound familiar yet? In Texas alone, developers built enough office space to accommodate every worker in Houston twice over. Dallas saw vacancy rates hit 30% by 1987. The same pattern repeated in Arizona, Colorado, and California. These weren't small-time operators making bad bets. These were respected institutions, lending to established developers based on appraisals that assumed perpetual growth. The Federal Home Loan Bank Board documented that by 1988, nearly 40% of commercial real estate loans in the Southwest were non-performing. When the commercial market saturated and vacancy rates climbed, the developers couldn't make their loan payments. The S&Ls that had loaned them the money suddenly faced a choice: admit the losses or extend and pretend. Most chose to pretend, rolling over bad loans and hiding the true state of their balance sheets. Federal regulators eventually forced the reckoning, and when they did, the contagion spread faster than anyone anticipated. Within 3 years, over 1,000 financial institutions collapsed. The ultimate cost to American taxpayers reached $132 billion, or is equivalent to about $300 billion in today's dollars. But here's the part that connects directly to our current situation. Homeowners who were making their mortgage payments on time still lost their homes. Not to foreclosure in the traditional sense, but to forced sales when the S&Ls holding their mortgages went under and assets had to be liquidated quickly to pay depositors. People who thought they were safe, who had stable jobs and manageable payments, found themselves caught in a systemic failure that started in commercial real estate and metastasized through the banking system into residential markets. The Federal Deposit Insurance Corporation documented cases of families with performing loans who received notices that their mortgages had been sold to vulture investors at steep discounts, investors who then pressured them to refinance at higher rates or sell. In some cases, homeowners saw their mortgage terms change overnight when their S&L failed and their loan was transferred to an acquiring institution with different servicing standards. Now let me show you why our current situation is actually more dangerous than the S&L crisis, despite what the optimists on financial television want you to believe. We've added a layer of complexity that didn't exist in the 1980s: derivatives. According to the Bank for International Settlements, the total notional value of derivative contracts in the global financial system now exceeds $210 trillion. That's 8 times the entire U.S. gross domestic product. And a significant portion of these derivatives are interest rate swaps tied directly to real estate. What's an interest rate swap, and why should you care? Banks use these contracts to hedge their exposure to interest rate changes. When a bank makes a 30-year mortgage at a fixed rate but funds it with short-term deposits, they face the risk that rising interest rates will squeeze their profit margins. So they enter into swaps with other financial institutions, essentially betting on where interest rates will go. When these bets go wrong, the losses can be catastrophic. Deutsche Bank gave us a preview of what's coming in November 2024 when they reported a $1.2 billion loss on real estate derivatives. That's billion with a B, from one bank in one quarter, from contracts that were supposed to reduce risk. The loss came from their counterparties, the institutions on the other side of their hedges, suddenly looking a lot less creditworthy as commercial real estate values plummeted. This is how systemic risk propagates in modern finance. Not through one bank failing, but through the web of interconnected derivative contracts that tie the entire system together. But Deutsche Bank isn't alone. UBS reported $800 million in real estate-related derivative losses in Q4 2024. Credit Suisse, before its acquisition, had exposure to nearly $50 billion in real estate swaps. These aren't outliers. They're canaries in a coal mine filled with explosive gas. The Office of the Comptroller of the Currency tracks derivative exposure across U.S. banks, and their Q1 2025 report showed that the top 25 commercial banks held $3.2 trillion in real estate-linked interest rate derivatives. When counterparty risk rises in this interconnected web, every institution starts questioning every other institution's ability to pay. Think about what this means in practical terms. Your regional bank makes you a mortgage and immediately hedges that interest rate risk with a swap contract involving a larger institution. That larger institution has swap contracts with dozens of other banks, insurance companies, and investment funds. When commercial real estate starts failing and one institution takes heavy losses, their counterparties suddenly question whether they'll be able to pay on their swap contracts. Confidence evaporates, and banks start pulling back from all real estate lending, both commercial and residential, because they can't separate the risks anymore. We're already seeing the early tremors of this confidence crisis. According to the Federal Reserve's Senior Loan Officer Opinion Survey from Q2 2025, banks have tightened lending standards on commercial real estate loans more dramatically than at any time since 2008. But what most analysts are missing is that this tightening is spilling over into residential lending as well. Banks aren't making distinctions anymore. They're seeing real estate as a category to avoid. Average down payment requirements have crept up from 10% to 15% for conventional loans at many regional banks. Debt-to-income ratios that were acceptable at 43% are now being scrutinized if they exceed 38%. Now let's talk about the rate lock paradox, because this is where the situation gets truly precarious. Remember those 63 million homeowners locked into sub-6% mortgages? That number is shrinking faster than most people realize, and when it breaks, it's going to break hard. Federal Reserve data from Q2 2025 shows that only 20.4% of outstanding mortgages now have rates below 3%, down from 24.6% in 2021. Every month, some of those ultra-low rate mortgages disappear as people move for unavoidable life reasons, pass away, or refinance. Do the math with me here. If 20% of homeowners have rates below 3%, another 30% have rates between 3% and 5%, and about 30% have rates between 5% and 6%. That leaves roughly 20% of homeowners with rates above 6%. That's approximately 10 million households who are not meaningfully locked in at all. They're already paying rates close to what they get if they move today. These 10 million households represent the first wave of sellers when the pressure releases. They're the ones who've been holding off because of general economic uncertainty or because they've been waiting for prices to go higher, but they don't face the same mathematical penalty as the truly locked-in borrowers. When commercial real estate stress hits regional banks and credit conditions tighten further through late 2025 and early 2026, these marginal sellers will rush to get out before conditions worsen. Here's a concrete example of how this plays out. Take a homeowner in Phoenix who bought in late 2022 with a 6.5% mortgage rate. Their house has appreciated maybe 8% since purchase, giving them some equity cushion. They've been thinking about moving back to California for family reasons, but kept delaying the decision. When they see news reports about regional bank stress, when they notice their own bank tightening requirements for new buyers, when they hear that their neighbor's home just sold for 5% less than the asking price after sitting on the market for 90 days, suddenly that decision becomes urgent. They list immediately, hoping to sell before the market softens further. Multiply this psychology across 10 million households, and you see how quickly waiting and watching turns into rush for the exits. Here's where it gets mathematically inevitable. When 10 million homeowners with rates above 6% decide to sell within a compressed time frame, they flood the market with inventory just as the pool of qualified buyers is shrinking. Mortgage Bankers Association data shows that every percentage point increase in mortgage rates eliminates about 15% of potential buyers from the market due to affordability constraints. At 7% rates, we're already down to a buyer pool that's 40% smaller than it was when rates were at 3%. When you factor in the tighter lending standards banks are implementing, the buyer pool shrinks even further, possibly by another 20% as marginal borrowers who would have qualified in 2023 now get rejected in 2026. Supply surges while demand contracts. This is Econ 101, the kind of imbalance that resolves through price discovery, which is a polite way of saying price drops. But unlike 2008, when subprime borrowers with unsustainable loans were forced to sell through foreclosure, this correction will be driven by choice and circumstance among borrowers with solid credit who simply need to move and can absorb the payment increase. The National Association of Realtors reported in June 2025 that inventory levels in major Sunbelt markets, Austin, Phoenix, Boise, Las Vegas, are already 50% above pre-pandemic levels. These are the markets that saw the biggest price increases during the pandemic buying frenzy, where remote workers flooded in seeking affordability and space. Now, those same markets are seeing the early stages of oversupply as investors who bought rental properties face negative cash flow and workers who relocated discover they actually need to return to coastal job markets for career advancement. Austin tells the story perfectly. In 2021, homes sold in an average of 12 days with multiple offers above asking price. By mid-2025, the average days on market had stretched to 65 days, and sellers were accepting offers 3% to 5% below asking price just to close deals. Inventory had tripled from pandemic lows, yet prices were still elevated by historical standards, propped up by the lock-in effect keeping would-be sellers on the sidelines. Real estate economists at Texas A&M documented that nearly 40% of Austin homeowners surveyed in Q1 2025 said they would consider selling if not for their low mortgage rates. That's potential inventory waiting to be unlocked. What we're witnessing is the slow-motion unraveling of the pandemic-era assumptions about where Americans would live and work. The derivative exposure adds a layer of systemic fragility. The commercial real estate defaults create the banking stress. The rate lock paradox ensures that when the break comes, it comes as a flood rather than a trickle. These aren't separate problems. They're different facets of the same crisis, all building toward a convergence point in 2026. The evidence isn't hidden in obscure economic journals or insider trading patterns. It's right there in the Federal Reserve data, the bank earnings, reports the commercial real estate delinquency statistics, and the simple mathematical reality of how many homeowners actually face a meaningful rate penalty versus how many are on the edge of the lock-in effect and ready to move. We're not speculating about human psychology or trying to predict irrational behavior. We're watching pressure build in a system that has only one way to release it, through price adjustment in the housing market. Now let me walk you through exactly how this unfolds, quarter by quarter, because understanding the timeline gives you the power to act before the crowd realizes what's happening. This isn't prophecy, it's pattern recognition based on how financial stress propagates through interconnected systems. Q2 2026 marks the beginning of visible stress. By spring, those $560 billion in commercial real estate loans reaching maturity will have forced enough regional banks to recognize losses that the market can no longer ignore the problem. According to TREP, a commercial real estate data analytics firm, approximately $180 billion in office loans alone mature between April and June 2026. These are not loans that can be easily refinanced when the underlying properties are worth 40% less than the original loan amounts. Watch for the warning signs in regional bank earnings reports. When you see terms like elevated loss provisions for commercial real estate exposure or increased reserves for potential loan losses, that's banker speak for we're bracing for impact. The Federal Deposit Insurance Corporation will likely release a special report on banking sector stability sometime in Q2 2026, and the language they use will tell you how serious regulators think the situation has become. If they start talking about heightened supervisory attention to certain institutions, that means they're already in crisis management mode behind the scenes. Q3 2026 is when the lock-in effect begins to break in earnest. Summer is traditionally the peak season for home sales. Families want to move before the school year starts. Weather is favorable for moving, and vacation schedules align with house hunting. This is when those 10 million homeowners with rates above 6% will list their properties in significant numbers. Real estate analysts at John Burns Research and Consulting project that inventory could increase by 30% to 40% year over year in July through September 2026, concentrated in the markets that saw the biggest pandemic price spikes. But here's the critical factor that most market observers are underestimating. Those new listings will hit a market where buyer demand is constrained not just by high interest rates, but by tightened lending standards from stressed banks. Zillow's affordability index already shows that only 15.5% of households can afford the median-priced home at current rates, down from 32% when rates were at 3%. When you layer on stricter underwriting requirements, higher down payments, lower debt-to-income ratios, more stringent income verification, that 15.5% could drop to 12% or lower by mid-2026. Do the math on what that means. If inventory increases by 35% while the pool of qualified buyers shrinks by another 20%, you need significant price reductions just to clear the market. Housing economists at the Urban Institute estimate that every 10% increase in inventory without a corresponding increase in demand results in 3% to 4% price declines. So a 35% inventory surge could trigger 10% to 15% price corrections in the most affected markets. Q4. 2026 brings the full convergence of inventory surge and demand collapse. By October through December, sellers who listed in summer without accepting early price cuts will become desperate to close before year-end for tax reasons or because their circumstances have changed. Phoenix, Austin, Boise, Las Vegas, and Nashville will see the sharpest corrections because these markets have three factors aligning against them. Inventory already 50% above pre-pandemic levels. As of mid-2025, speculative investor purchases during the boom years creating shadow inventory, and local job markets that haven't sustained the growth rates that justified the pandemic price increases. Let's get specific about what 10% to 15% corrections look like in dollar terms. Now let's talk about your personal calculations, because this is where theory becomes actionable intelligence. If you're a homeowner, you need to know three numbers right now: your current loan-to-value ratio, your move threshold, and your cash runway. Your loan-to-value ratio is simple. Divide your current mortgage balance by your home's estimated value. If you owe $320,000 and your home is worth $400,000, that's 80% LTV. Here's the critical threshold. If your LTV is above 85%, you face underwater risk. If prices drop, just 15%. Check your mortgage statement for the current balance, then get a realistic estimate of your home's value. Not what you hope it's worth, but what similar homes in your neighborhood have actually sold for in the past 90 days. Real estate sites like Redfin and Zillow can give you recent comparable sales data. Your move threshold is the calculation that tells you when life circumstances justify taking the payment increase from moving. Take your current monthly mortgage payment and multiply it by 1.8 to estimate what a new mortgage at 7% would cost you. That's roughly the payment increase ratio most homeowners with sub 4% rates would face. If you're paying $2,000 monthly now, moving would cost you $3,600 monthly, an increase of around $600 or $1,900 annually. Can your household absorb that increase? Should you absorb it if moving gives you better job opportunities, lowers other costs, or significantly improves quality of life? This is a personal calculation, but doing the math now prepares you for making clear-headed decisions when circumstances change. Your cash runway matters more than ever as credit markets tighten. According to J.P. Morgan Chase Institute research on household finances, the median American household has about 3.5 weeks of liquid savings to cover expenses. That's dangerously inadequate in a normal environment and catastrophically insufficient heading into a period of potential financial stress. You want 12 months of essential expenses and liquid savings, not 12 months of your current lifestyle, but 12 months of your absolute bare minimum, mortgage or rent, utilities, food, insurance, debt payments. This cash buffer gives you the ability to weather job disruption, wait out a weak selling market, or pivot when opportunities arise. For those of you who are still locked in with sub 4% rates and substantial equity, your calculation is different. You have optionality, the luxury of choosing when to move rather than being forced by circumstances. But that optionality comes with responsibility. You need to monitor the indicators I've outlined and be prepared to act before the window closes. If you're planning to move within the next 3 to 5 years anyway, seriously consider accelerating that timeline to mid-2026 before the inventory flood peaks. Yes, you'll face a payment increase, but you'll do it while you still have equity cushion and before competition from distressed sellers drives down your sale price. Now here's the part that should concern every American who cares about economic fairness and opportunity. This isn't going to be a 2008-style crash, where foreclosures force families out of their homes. This is something more insidious, a soft lockout that traps middle-class families in place while transferring opportunity to institutional investors and the wealthy. Think about what happens when you lose 15% of your home equity, but you're still making your mortgage payments. You don't face foreclosure, you're not forced to sell, but you become trapped. You can't move for that better job in another city because you don't have enough equity to make a down payment on a new home, and you can't afford the payment increase. You can't downsize in retirement because the equity you were counting on to fund your next chapter has evaporated. You can't upsize when your family grows because your borrowing capacity has been cut by the combination of higher rates and lost equity. Core logic. A real estate data analytics firm estimates that a 15% price correction combined with current interest rates would trap approximately 12 million American families in their current homes, not because they want to stay, but because moving becomes mathematically impossible. That's 12 million families who lose the mobility that has historically been central to American economic opportunity. The ability to move for education, for career advancement, for family needs, for a better quality of life. Meanwhile, institutional investors with cash reserves are positioning themselves to buy the distressed inventory at discounted prices. According to the National Rental Home Council, institutional investors already own 3% of single-family homes in America, up from 1% before 2008. In some markets like Atlanta and Phoenix, that percentage exceeds 10%. When the 2026 correction happens and sellers become desperate, these institutions will deploy capital to acquire properties at 15% to 20% below peak prices, convert them to rentals, and lock in long-term cash flow from the very families who lost the opportunity to build wealth through homeownership. This is the wealth transfer mechanism that operates in plain sight. Economic stress doesn't destroy wealth, it redistributes it. The equity that vanishes from middle-class balance sheets does not disappear into thin air. It transfers to those with the capital to buy during the correction and the patience to hold through the recovery. The U.S. Census Bureau projects that by 2030, the homeownership rate could drop from the current 66% to below 62%, with institutional ownership rising to compensate. That means millions more American families paying rent to corporate landlords instead of building equity for themselves and their children. So, what do you do with this information? First, you calculate your own exposure using the numbers I gave you: LTV, move threshold, cash runway. Second, you make decisions based on your specific situation, not on general market optimism or pessimism. Third, you recognize that being prepared isn't the same as being panicked. Understanding systemic risk gives you an advantage, but only if you act rationally rather than emotionally. If you're trapped with high LTV and low rates, focus on building that cash runway and reducing other debts to increase your financial flexibility. If you're planning to move anyway, consider acting before Q3 2026. If you're looking to buy, understand that patience could be rewarded with better prices by late 2026, but also prepare for tighter lending standards that might make qualifying more difficult, even with lower prices. The lights are on now. You're no longer sleepwalking toward 2026. You see the path and the obstacles ahead. What you do with that awareness, that's your choice to make. But at least now you're making that choice with open eyes, understanding the forces at work, and calculating your options based on facts rather than hope. That's the difference between being a victim of systemic change and being someone who navigates it successfully. The cliff is real, but you don't have to step off it just because millions of others will. If you made it this far, you're the kind of person who wants to understand what is really happening before the mainstream catches on. Hit that subscribe button so you're positioned ahead of the next wave, and drop a like if this analysis helped you see the patterns others are missing. In our economy, the informed adapt, while the unaware get adapted to, and I'd rather have you in the first group.